Good afternoon, and welcome back to our channel. Before we dive into today's analysis, I'd like to invite you to subscribe for more thoughtful, disciplined insights into financial markets. Subscribe button, red. We focus on helping you develop the emotional discipline and strategic thinking needed to navigate complex market cycles. Your subscription helps us continue providing these in-depth perspectives. Now, let's examine one of the most overlooked relationships in precious metals markets today. The gold to silver ratio currently sits at levels that have historically preceded some of the most dramatic wealth transfers in modern financial history. Yet most investors are making the same mistake they've made for decades. They're buying silver at precisely the wrong time. This isn't about missing an opportunity. It's about understanding a fundamental relationship that could determine whether your precious metals allocation becomes a cornerstone of generational wealth or a cautionary tale about market timing. The silver trap isn't what most people think it is. It's not about manipulation or conspiracy theories. It's about understanding when patience becomes your most valuable asset. The gold to silver ratio measures how many ounces of silver it takes to purchase 1 ounce of gold. When this ratio is high, silver is relatively cheap compared to gold. When it's low, silver is relatively expensive. This sounds simple, but the implications run much deeper than most investors realize. Throughout recorded history, silver has traded at ratios ranging from 12 to 1 during the Roman Empire to over 100 to 1 during periods of extreme market stress. The ratio isn't just a mathematical curiosity. It's a window into market psychology, monetary policy, and industrial demand cycles. Today's ratio tells us something important about where we stand in the precious metals cycle. But more importantly, it reveals why timing your entry could be the difference between substantial wealth creation and years of frustration. Let's examine 3 critical periods where the gold to silver ratio provided clear guidance for strategic investors. In 1980, the ratio reached 17 to 1 just before silver peaked at over $50 per ounce. Investors who bought silver heavily during this period watched their holdings decline for the next 2 decades. Those who understood the ratio's warning signs avoided this trap entirely. During 2008's financial crisis, the ratio spiked to 84 to 1 as industrial demand collapsed and investors fled to gold's perceived safety. Smart money recognized this as a generational opportunity. Silver subsequently outperformed gold by more than 300% over the following 3 years. In 2020, the ratio peaked at 125 to 1 during the initial pandemic panic. Again, those who understood the historical significance of such extreme readings positioned themselves for silver's dramatic recovery that followed. Each cycle teaches us the same lesson. The ratio doesn't just measure relative value, it measures fear, greed, and the collective emotional state of precious metals markets. Precious metals markets move in long, predictable cycles driven by fundamental forces that most investors ignore. These cycles typically span 15 to 20 years, encompassing periods of accumulation, markup, distribution, and decline. Currently, we appear to be in the early stages of a new accumulation phase. Gold has been making new highs, but silver remains well below its historical peaks. This divergence creates opportunities for those who understand the underlying dynamics. During accumulation phases, smart money moves quietly into undervalued assets, while retail investors remain focused on recent momentum. The gold to silver ratio serves as a roadmap for this process. When institutions and central banks increase gold reserves, they create the foundation for silver's eventual outperformance. Silver's dual role as both a monetary metal and industrial commodity means it benefits from both monetary debasement and technological advancement. But timing remains critical. Enter too early, and you'll endure years of opportunity cost. Enter too late, and you'll miss the exponential phase entirely. Silver's industrial applications continue expanding at an unprecedented rate. Electric vehicles require twice as much silver as traditional cars. Solar panels consume approximately 20% of annual silver production. Semiconductors, medical devices, and emerging technologies create additional demand pressure. This industrial component distinguishes silver from gold in fundamental ways. Gold's primary drivers remain monetary and jewelry demand. Silver faces supply constraints from both investment demand and irreplaceable industrial consumption. When the gold to silver ratio reaches extreme levels, it often reflects temporary dislocations in industrial demand. Economic slowdowns reduce immediate consumption, but they don't eliminate the underlying technological trends driving long-term demand. Understanding this distinction helps explain why silver experiences more volatile price movements than gold. It also reveals why patient investors who accumulate during industrial demand lulls often achieve superior long-term returns. Central bank policies play a crucial role in precious metals cycles. Quantitative easing, negative real interest rates, and currency devaluation create the monetary backdrop for metal appreciation. The current global monetary environment remains unprecedented in its scope and duration. Multiple central banks maintain accommodative policies despite persistent inflationary pressures. This creates conditions historically favorable for precious metals appreciation. Gold typically leads during the early stages of monetary debasement as institutional investors seek store of value alternatives. Silver follows once the monetary thesis gains broader acceptance and risk appetite returns. The gold to silver ratio often peaks during periods of maximum monetary uncertainty. As confidence returns, silver's leverage to the precious metals thesis becomes apparent to a wider investor base. This sequence has repeated throughout modern monetary history. Understanding where we stand in this cycle provides crucial context for allocation decisions. Several technical and fundamental indicators suggest we're approaching a critical inflection point in precious metals markets, but these same signals also highlight why patience remains essential. Gold's recent strength against major currencies indicates growing institutional acceptance of the monetary debasement thesis. Central bank purchases continue at elevated levels, suggesting professional money managers recognize gold's portfolio benefits. Silver's relative underperformance creates the setup for eventual outperformance, but the timing depends on factors beyond precious metals markets themselves. Industrial silver demand remains constrained by global economic uncertainty. Supply chain disruptions continue affecting production and distribution. Investment demand flows remain inconsistent as retail investors chase momentum in other asset classes. These conditions create both opportunity and risk. Opportunity for those who accumulate quality positions during periods of disinterest. Risk for those who mistake short-term catalysts for sustainable trends. If you currently hold precious metals positions, this environment demands careful evaluation of your allocation strategy and risk management approach. First, assess your current gold to silver allocation against the historical ratio. If you're overweight silver relative to gold, consider whether this positioning aligns with current market conditions and your timeline for liquidation. Existing silver holders should resist the temptation to add aggressively to positions based on short-term momentum. The ratio suggests patience will be rewarded, but timing remains uncertain. Instead, focus on optimizing your storage costs and ensuring liquidity when opportunities arise. Review your dealer relationships and understand the bid-ask spreads for different product categories. Consider dollar cost averaging any additional purchases, rather than attempting to time major positions. This approach reduces the impact of short-term volatility while maintaining exposure to longer-term trends. Most importantly, resist emotional decision-making based on daily price movements. Precious metals investments require discipline measured in years, not months. For those considering initial precious metals exposure, current conditions offer both opportunity and important timing considerations. Begin with gold as your foundation position. Gold's monetary characteristics and lower volatility make it more suitable for portfolio allocation during uncertain market conditions. Establish a systematic accumulation approach. Rather than attempting to time major purchases, dollar cost averaging over 12-18 months reduces timing risk while building meaningful exposure. Consider starting with 5 to 10% portfolio allocation to precious metals, with gold comprising 70 to 80% of that allocation initially. This provides exposure to the sector's benefits while maintaining appropriate risk management. Study the gold to silver ratio and prepare to adjust allocations as conditions evolve. When the ratio reaches historical extremes, consider increasing silver's percentage of your metals allocation. Avoid leveraged products or speculative mining stocks until you understand the underlying physical markets. Complexity increases risk and reduces the hedging benefits that make precious metals attractive. Several behavioral mistakes consistently destroy wealth in precious metals markets. Recognizing these patterns helps investors maintain discipline during emotional periods. Chasing momentum represents the most common mistake. Precious metals investments require contrarian thinking and patience. Following crowd psychology leads to buying high and selling low. Over-leveraging positions through futures, options, or margin creates unnecessary risk. Precious metals serve best as insurance and store of value assets. Speculation transforms them into high-risk investments. Ignoring storage and insurance costs undermines long-term returns. Factor these expenses into your investment analysis and optimize storage solutions for your specific situation. Emotional trading based on daily news creates transaction costs and timing errors. Establish clear criteria for position changes and stick to your predetermined strategy. Concentrating too heavily in precious metals reduces portfolio diversification benefits. Maintain appropriate allocation percentages based on your overall investment objectives and risk tolerance. Failing to understand tax implications can significantly impact net returns. Consult with qualified tax professionals regarding collection strategies and potential alternatives. Proper risk management begins with understanding precious metals' role in your overall portfolio strategy. These assets serve specific purposes that shouldn't be confused with growth investments or income generation. Precious metals provide inflation hedging, currency devaluation protection, and systemic risk insurance. They don't generate cash flow or earnings growth like productive investments. This distinction affects appropriate position sizing and return expectations. Allocate capital you can hold for extended periods without requiring liquidity or income generation. Consider your investment timeline carefully. Precious metals can remain dormant for years before experiencing rapid appreciation. Ensure your allocation doesn't create pressure for premature liquidation. Diversify within the precious metals allocation across different products and storage methods. Physical metals, ETFs, and mining stocks each provide different risk-return characteristics. Maintain emergency liquidity outside your precious metals positions. These investments shouldn't compromise your ability to meet short-term financial obligations. Successful precious metals. Investing requires mastering psychological challenges that defeat most participants. Understanding these emotional dynamics helps maintain discipline during difficult periods. Precious metals investments often experience long periods of poor performance followed by rapid appreciation. This pattern tests investors' patience and conviction repeatedly. During accumulation phases, metals holdings may lag other investments significantly. The opportunity cost creates psychological pressure to abandon positions just before major moves begin. Media coverage tends to be most negative during the best accumulation opportunities and most positive during distribution phases. Learning to think independently from popular sentiment becomes crucial. The gold to silver ratio itself creates psychological conflicts. When the ratio is high, silver appears cheap but often continues declining. When it's low, silver appears expensive but may continue rising. Developing conviction in your analysis helps overcome these psychological challenges. Study historical cycles and understand the fundamental forces driving precious metals demand. Current global economic conditions create a complex backdrop for precious metals investments. Multiple conflicting forces influence both short-term performance and long-term prospects. Persistent inflation pressures support the monetary debasement thesis, while creating political pressure for more aggressive policy responses. Central banks face difficult trade-offs between supporting growth and maintaining currency stability. Geopolitical tensions continue escalating across multiple regions. These conflicts increase systemic risk and support demand for alternative monetary assets. Supply chain disruptions affect both precious metals, mining operations, and industrial demand patterns. These dynamics create temporary dislocations that may resolve differently than historical precedents. Technological advances in mining and recycling could affect long-term supply conditions. However, increasing industrial applications may offset any production improvements. Understanding these macro-level forces helps maintain perspective during short-term volatility and supports conviction in long-term allocation strategies. Technological developments continue expanding silver's industrial applications while potentially disrupting traditional demand patterns. These changes affect both short-term price dynamics and long-term investment prospects. Electric vehicle adoption accelerates global silver demand as batteries and electrical systems require increasing quantities. Autonomous vehicles may further increase per-unit consumption. Renewable energy expansion, particularly solar panel deployment, creates additional industrial demand that's largely price inelastic. These applications consume silver permanently, removing it from recyclable supply. Semiconductor advancement requires increasingly pure silver for critical applications. As electronic devices become more sophisticated, silver content per unit may increase rather than decrease. Medical and biotechnology applications continue expanding as silver's antimicrobial properties gain recognition. These high-value applications can support demand even at elevated price levels. However, recycling technology improvements may increase secondary supply over time. Understanding both demand growth and supply responses helps inform long-term investment expectations. Central bank policies worldwide continue creating conditions historically supportive of precious metals appreciation. However, the timing and magnitude of these effects remain uncertain. Quantitative easing programs expand money supplies while maintaining artificially low interest rates. These policies reduce the opportunity cost of holding non-yielding assets like precious metals. Currency competition between major economies creates instability in foreign exchange markets. Precious metals serve as neutral alternatives when currency relationships become volatile. Debt monetization pressures increase as government borrowing requirements exceed private savings capacity. This dynamic supports the long-term case for monetary alternatives. However, policy effectiveness and market responses don't always align with historical precedents. Central banks possess tools and techniques that didn't exist during previous precious metals bull markets. Understanding policy constraints and potential responses helps anticipate market reactions and maintain appropriate positioning throughout different scenarios. Precious metals. Investing success requires adopting a wealth-building mindset rather than speculation or trading approaches. This perspective influences every aspect of allocation strategy and risk management. Focus on accumulating quality positions during periods of market disinterest rather than chasing momentum during popular phases. The best opportunities often occur when assets appear boring or forgotten. Maintain purchasing power preservation as your primary objective rather than maximum return generation. This approach reduces emotional pressure and supports better decision-making. Consider precious metals as portfolio insurance that occasionally provides exceptional returns rather than growth investments that provide defensive characteristics. Integrate precious metals into comprehensive wealth management strategies, including estate planning, tax optimization, and generational wealth transfer considerations. Remember that true wealth building occurs over decades, not years. Maintain perspective during both strong and weak performance periods. The current environment presents both opportunity and complexity for precious metals investors. The gold to silver ratio suggests patience will be rewarded, but timing remains uncertain. Focus on building conviction through education and analysis rather than following popular opinion or seeking confirmation bias. Understanding market cycles and psychological patterns provides more value than predicting specific price movements. Develop systematic approaches to accumulation and allocation that reduce emotional decision-making. Discipline consistently outperforms brilliance in precious metals markets. Prepare financially and psychologically for extended accumulation periods that may last longer than expected. The best opportunities often require the most patience. Stay informed about technological developments and macroeconomic trends that affect long-term demand patterns. Knowledge creates confidence during uncertain periods. The silver trap isn't about market manipulation or conspiracy theories. It's about understanding when patience becomes your most powerful investment tool. The gold to silver ratio currently sits at levels that have historically created exceptional opportunities for disciplined investors. But history also teaches us that timing these opportunities requires emotional discipline and strategic thinking rather than speculation or momentum chasing. Those who master the psychological challenges of precious metals investing often achieve results that transform their financial futures. Those who succumb to emotional pressures typically experience frustration and missed opportunities. The choice is yours. You can approach precious metals with the discipline of a strategic investor focused on long-term wealth preservation and growth. Or you can treat them as speculative vehicles subject to the emotional ups and downs of short-term market movements. The ratio will eventually explode, as it has throughout history. Your success will depend not on predicting exactly when this occurs, but on positioning yourself appropriately and maintaining discipline until it does. Build your conviction through knowledge. Manage your risk through proper allocation. And remember that in precious metals markets, patience isn't just a virtue. It's often the difference between financial security and missed opportunity. Thank you for your attention. Until our next analysis, stay disciplined, stay informed, and stay focused on your long-term financial objectives. Subscribe button, re-D.